I should probably tell you a little bit about Kinross as well. Kinross Gold, it engages in the acquisition, exploration, and development of gold properties, principally in North America and South America. So it's involved in the extraction and processing of gold, which has been a great segment to be in as of late because the price of gold has been doing well. But these companies that can actually extract the gold are printing presses for cash. They are doing incredibly well. So how would we know that? We can actually like look at the profitability grade. And when we look at the profitability grade, we click into it and you see all the underlying metrics. So the overall profitability grade for Kinross is an A plus. But if you click on profitability, it will immediately show you those underlying metrics, such as gross profit margin, EBIT margin, EBITDA, net income, return on equity, cash from operations, cash per share. And you'd see the gross profit margin for this company with an A grade is 62%. So that gross profit margin is 62% versus the sector at 29%. And you can see underneath that, the EBITDA margin is at 56% versus the sector at 17%. So an A plus. So it becomes very intuitive. You see the grades, and then you see what the actual metric is, and the sector's median metric as well can quickly begin to say, oh, now I know why this is an A, or now I know why it's a D. We make it very clear and straightforward. So that is Kinross Gold. Our second stock is CommScope Holding, ticker symbol COMM. A bit of a different industry. We're going from gold to information technology and communications equipment. And this, is a similar situation. This stock has done really well too, but it's growing and the valuation framework is good. So the value grade on CommScope Holding is a B. The growth grade is a B. The profitability grade is a B plus. The momentum grade, and momentum again relative to the sector, it's an A plus. So it's crushing all the same stocks in the sector. And the revisions grade is an A minus, which means that analysts are taking their earnings estimates up at a faster pace compared to other companies in the sector. This company provides infrastructure solutions and communications for data centers. And data centers are sort of like the new Pac-Man for energy. They are just consuming huge amounts of energy right now. Obviously, that has a lot to do with the power needed to run chips for semiconductors and artificial intelligence. So data centers are growing like wild, and their demand for energy is growing like wild. And this company provides infrastructure solutions for data centers, entertainment networks, and communication centers. So our number two stock, as I mentioned, is CommScope Holding. Looking at the factor grades, green across the board with Bs and As, and it has a quant strong buy. And our third stock that you would find in both Alpha Picks and the Pro Quant Portfolio would be another mining company. This is SSR Mining, ticker symbol SSRM. So this is, again, a mining company that's primarily in North America. This stock has had a big run up too over the last year. I'm not going to lie, it's up 272%. But the growth grade right now is an A plus relative to the sector, and that's exactly where it was 6 months ago. The value is still good. It's got a value grade of a B. 6 months ago was an A minus. So the valuation is a little bit more expensive than what it was, but relative to the sector, the stock is cheap. So if I click into the value grade and I look at PE, I'll see the PE, the forward PE is 14 times for this company versus the sector at 16 times. So it's actually at a 12% discount to the sector. And if I were to look at it on a PEG basis, it's an A plus for PEG. Its metric comes in at 0.16 compared to the sector median at 1.38. So on a PEG basis, this is at an 88% discount to the sector. It's extremely cheap versus the sector. So even though the stock has had a major run up, you're looking at a stock that's really, really cheap that has had incredible growth. So when I'm looking at the growth and I look at the EPS forward growth, which is the consensus of analysts looking at the forward growth, it's 92%. So it's usually a 3 to 5 year CAGR growth rate that the analysts are projecting. So the consensus is that this company is growing at a 92% growth rate compared to the sector at 12%. If we were to look at the forward revenue growth, that's about 10% versus the sector at 3%. So even the revenue growth is at about a 220% premium to the sector. So that's exactly why the stock has been running so much, and it will probably continue to run so much because it's doing so well versus the sector.